I formally go and I talk about the paper over here, the FA. This is basically the financial accounting. As far as the exam format is concerned, we are going to have a section A. Section A is going to be 35 questions of uh, 2 marks each. So that is going to be 70 marks over here. And then we have section B over here. We have 2 questions over here of 15 marks each, and that is going to be 30 marks over here. And these are going to be a total of 100 marks. Passing is flat at 50%, right? Now, the point which I was about to say now, these 2 questions. Over here, question 1 is going to be from consolidation, 100% confirmed. 100% it's confirmed that you are going to get the consolidation question over here. And then the question number 2 is going to be from the final accounts. It can be from the cash flows, and it can be from the ratio analysis as well, right? So there is a higher chance that you will be getting a question from the final accounts over here or the cash flows. Ratio is a bit on a lower side. I mean, the candidate for the question is concerned, but it can be there because this is something analytically speaking, or from the performance evaluation point of view is concerned. This is something which the examiner can test in other papers as well. But the final accounts, the cash flows, these are the ones which are explicitly the topics of the FA. So he's gonna be more interested in giving you this question over here. And yes, one more thing. These questions, I mean, not the consolidation, but to some extent, yes, it can be. But overall speaking, this question too is going to be a sort of MTQ over here. MTQ is multitask question. Multitask question it is going to be. Multitask question means you are going to have one scenario, and under that you are going to have 5 questions, 1, 2, 3, 4, 5, 2 marks each. And the examiner is going to ask you that what is the answer for this, what is the answer for that, what is this, what is that. I mean, related to the scenario, obviously speaking. Or what you can have over here as well, or you will have predefined format with the blanks, or choose from the following. That is, you are going to have a button to choose from. For example, add or subtract. You have to decide about an amount that is going to be added or subtracted. So you have to choose the option over here that either you are going to add or you are going to minus. And similarly, on the right side, you have a fill in the blank where you have to write or type in the amount. For example, 1500, 2000, 18,000, 20,000, whatever that is, right? So over here, I will be guiding you. I will teach you what the format is, how to, memorize it, right? Logically. So that when you have this question in the examiner where you just have to fill it up, although even if you don't memorize the format, it's fine. If you just clear yourself that what is going to be the addition, what is going to be the subtraction, that is going to be more than enough. But again, this is something that you have to do the memorization part, so that when you are sitting and doing the question, you are 100% clear about what you are going to do. Similarly, for the consolidation part, we are going to learn around 3 to 5 adjustments over here of the consolidation, the basics, purely basics, right? 3 to 5 adjustments, pure basic, we are going to learn, and we are going to learn the basic principles of the consolidation. Now, as far as the consolidation is concerned, ratios is concerned, cash flow is concerned, they can be over here in the section A as well, right? They can be in the section A as well. I mean, you can be asked a 2 mark question related to any of these parts, right? So section A will be 100% of the syllabus or the area that you are going to cover. But section B is explicitly going to be from these topics: consolidation, final accounts, cash flow, and the ratios. This is what the section B is going to be, or the second half of the paper is going to be, right? Okay, now moving ahead from here, let's just talk about the two types of accounting. One is financial accounting, one is management accounting. Financial accounting used for it's used for communicating, or it's communicated outside the organization. In order to, like, communicate outside the organization, you use a financial accounting. We have summarized information, we have accounting standards, we have set presentation tools, that is the financial statements. We have to prepare at least annually, right? These are generally required by law, right? And they reflect the past performance and position of the company, right? This is what for the financial accounting is. And then for the management, it's used for to communicate in-house, or it's used for in-house communication. There is a detailed information. There are no accounting standards over here, no set presentation criteria. There is no limit for presentation. They can be prepared weekly, monthly, quarterly, or yearly, right? Not required by law. They reflect the future performance and position of the company, right? So this is what we have overall as far as the management accounting is concerned. Now, let's talk about these points one by one in order to clear the picture. When you want to, communicate outside the organization, you are going to use the financial accounting. And when are you doing the in-house communication to tell about your result, to tell about your business, to tell about what you are doing, to tell about what you have earned, to tell about what you have lost, you are going to use the management accounting. The very first point comes in the mind, I mean, if you have thought about it or not, why do we want to communicate outside the organization what we are doing? I mean, a logical question comes in mind, now, that why on earth we need to communicate outside the organization that what we are doing? The answer to this is, normally in the big businesses, like in the companies, this is the investment of the general public at large, being called as the shareholders, right? It is the investment, or it is the amount, or it is the money of the shareholders with which the management is playing, right? So obviously, they need to have an update about what you have done the whole year. So you have to communicate outside the building to the investors, to the shareholders, that what you have done in the whole year, what you have earned, what you have lost, where you are standing. So that is why we need to communicate outside the organization. Now, when you are communicating outside the organization, like say in case you are a car manufacturer, how are you going to communicate? You are simply going to say that during the whole year, we sold 100,000 cars. We had a total revenue of 1 million or 10 billion or whatever the amount. This has been our cost. This is our profit. These are our expenses. At the end of the day, we paid this amount of tax, and this is our net profit. Coming towards the other financial statement, the balance sheet or the statement of financial position, you are going to simply say that these are our assets, these are our liabilities. That's it. No need to go into the details. I mean, technically and logically speaking, what's the point of telling them how have you manufactured the car? Right? There's no point of telling them. I mean, they don't need this information. Technically speaking, over here in Pakistan, I have the shares of a local telephone company called as the PTCL, Pakistan Telecommunication, right? I have the shares of the PTCL over here. I have the connection to the PTCL at my place as well. I'm using the internet connection from the PTCL as well. Now, I am least concerned with how the PTCL is working at my place. I don't know. At the top of some building, somebody is holding an antenna or a dish and pointing at my house so that I can get the signals of the PTCL for my Wi Fi or for my telephone or for whatever, right? I'm least concerned with that. All I'm concerned is if I have invested an amount in the company, so what is the return I'm getting at the end of the day? I'm least concerned with how and what is happening, logically speaking. Simple, right? I'm least concerned how and what other stuff is happening. So you don't have to go into the details. But when it comes towards the in house communication and the management accounting, you need to go into the details. You have to look at the recipe of how you are manufacturing the car. What can be done to reduce the cost? If you are manufacturing something in house, what if you buy it outright, right? You buy it outside from some supplier in a ready made way. Will it be cheap? Or if you make it in house, is it gonna be cheap? If you are selling the car at a certain price, why are you selling at that? Why not at a lower? Why not at a higher? How can you increase your margins over here? How can you reduce your cost over here? How can you go for, the response towards, as far as the new market which you have explored, what has been the response of the market over there, geographically speaking, product wise speaking? You go into the detailed informations. You go into, like, the detailed, the presentation as well, that what is happening or what is not happening. But over here, we don't have to go in details. We are gonna be summarized to the point. That's it. Then we have the accounting standards over here. These are accounting standards are the rules, convention, base, criteria, skeleton on which the whole of the financial accounting is based upon, right? These accounting standards are the rule based criteria, convention, skeleton on which the whole of the financial accounting is based upon. So we have to follow the rules. How much rules are important over here? Like, if we talk about the format as well, like even if we have to draw a line in the statement of comprehensive income or the financial position, if we are putting up a line as well now, there is going to be, or that is going to be backed by an accounting standard. You cannot randomly put up a line anywhere. You cannot randomly make up a format anywhere, right? Now, We have the set presentations tools, like for example, the financial statements over here. We have the set accounting rules to follow as well, but no such presentation tools or no such accounting rules over there. Why is that? I mean, why do we need to have a set pattern, set criteria, set accounting standards? Now, remember, whenever someone asks you that why do you want to have something, so rather than telling them why do you want to have something now, always explain the need via the issue or the impact of not having it, right? Let me rephrase myself, that if you want to emphasize on something now and you want to justify something, then don't say that if I have this or if this is over here, then this will happen, this will happen, this will happen. No, justify like this, that if we don't have this thing, then what is happening, what is being missed. This is more impactful. Like for example, if you have the accounting standards, why are you having the accounting standards, or why do you have the accounting standards or the set presentations tools? Now what will happen if there are no set rules or pattern? Then the person in the Mauritius is going to make up the financial statements according to his or her own desire. Me sitting in Pakistan, I'm going to make up the accounts according to myself. Similarly, the person sitting in the States, in the Canada or the Australia or the Europe, he is going to make up the accounts according to his own will or desire. Now, what is going to happen? When you, me, I, they, everyone, they are going to make the accounts on their own, they will not be comparable. We won't be able to compare them. We won't be able to, like, understand them, because in order to understand, we will have to learn first that how or via what approach you have made up the accounts. We will have to learn that as well, right? So technically, if you have to learn that as well, so what does it mean? It means that everyone making up the accounts, they end up making up the accounts according to their own will, according to their own desire. So it means the point of comparison is gonna be like gone from that point, or is gonna be evaporated from that area. And then obviously when we go out to take up a loan from a company or a bank or something, now they rely on the financial statements. Now, if they are not being prepared following a rule or a regulation or an accounting standard, so the reliability factor is going to be a question mark as well, right? So that is why you need to have the rules to have a base of comparison, and along with the comparison, you need to have a rule or a base via which, at the end of the day, you know you can do the reliability and the comparison as well, right? So that is something which is going to be there. Then in the financial accounting, the accounting standards, they, or not the accounting standard, but rather the information that we have to present, the rule is that we have to present it at least annually. At least annually you have to make a one set of accounts to let the outside world know what you're doing, right? And the preparation of accounts, these are generally required by the law. There is the company law which exists, that you have to prepare your financial statements at least annually. At least annually means that at least one time making up your accounts, at least make them in the 12 months, at least one time, right? Then they reflect the past performance and the position of the company. Now, this point is very, very interesting over here, related to the financial accounting. Being required by law, set presentation tools, accounting standards, summarized information, this and that, and whatever you say. Whatever you say. Believe me, when this point comes, na, reflect the past performance and the position of the company. Uh, you know, this is like I'm not good with the proverbs or all, and with the, like, English, in English, but it's just like, it just simply washes away everything, right? It's just like pouring the water on anything, or on everything. I mean, all the efforts, they just straight away go down the drain. Technically, the technicality of this point is this, in that way, that whatever you do, it just goes down the drain when this point is over there, that it reflects the past performance and position of the company. What does it mean? It means when you prepare the accounts now, when you inform outside the world that what have you done, see what I'm saying? What have you done? You are telling about the past, what you have done in the previous year, in the previous month, in the previous week, in the previous quarter. You are not telling them what you are doing right now. This is the inherent limitation of the accounts, that you always tell after the time period has passed, right? So, this is one of the issues of the financial accounting, right? So, it's all about the past performance. You tell them about what you have done in the past. And honestly, technically, generally speaking, your accounts, they cannot guarantee the future. Your current performance, it cannot guarantee the future. You can predict, you can estimate, or you can get an idea how the things are going to be. That's it. That's it. Not nothing more than that. Right? You can get an idea how the things are going to be, but you cannot guarantee them. You cannot confirm them. Right? So this is what, overall speaking, this financial accounting and its difference is. Now, as far as the accounting is concerned, it is the recording, summarizing, and presentation. When we use the word financial accounting, it is the recording, summarizing, and presentation of financial transaction, that you record, you summarize, and then you present the financial transactions over here. Financial means something in monetary value, something in monetary value. And the word transaction, what is a transaction? Anyone, any idea? What do you guys think? What's a transaction? Anyone? I mean, if you want to shed a light on it or something. Anyone want to share something? What is a transaction? No one? Okay, my silent warriors, let me help you. Transaction is basically when, okay, I got something. I got something. Okay. Bhamini is saying buying and selling. Okay, okay, fine. Thank you. Now, transaction, buying and selling, agreed upon, agreed upon. Agreed upon from the accounting point of view. You are absolutely right. The buying and selling is a transaction, but I have to look from a broader perspective. Transaction is when property changes hand to hand, or when exchange of interest occurs, it's called a transaction. Now, okay, I have an exchange between the two parties. Yes, Ms. Ashna, you're right. The exchange between the two parties, it's a transaction, absolutely right. So transaction is when property changes hand to hand, or when exchange of interest occurs, it's called a transaction. Now, what do I mean by the property changes hand to hand? Like, for example, I am teaching you, you are studying from me, right? I am speaking, you are listening, right? Similarly, if I have something in my hand and I give it to you, that is a transaction, right? So when the property is changing the medium, now that is a transaction. Simply, it can be anything. Like after the class, like you go downstairs or you go outside the room and you ask your spouse or you ask your mom or sister for the food, and they give you the food, right? So that is a transaction. Or if you have a bad like me, you go outside and then your spouse asks for the food from you, and then you prepare and give the food. That is something, what is a transaction, right? So your high command speaks and you just obey or you listen, that is a transaction. No need to go into the complexities and all. And then when exchange of interest occurs, it's called a transaction. You are sitting on that side of the that side of the screen, I'm sitting on this side of the screen. We are sitting over here at this time with this arrangement, with this class of the financial accounting. You have your interest, I have my interest. Why have you joined the class? You have joined the class so that you can study, right? So that you can get an idea about the FA, you can study about the FA so that eventually you can pass the paper. This is what your interest is. Now, what is my interest? What is my interest? What you think that I am sitting over here to do what? To teach you? No, that's not my interest. I mean, let's just get practical. That's not my interest. My interest, obviously, if I'm spending the time over here, my interest is the monetary terms, in the monetary terms that I have. Obviously, if I sit over here, if I teach you guys, I'm gonna get paid. That is my interest over here. So this whole one class, you guys are studying, I am teaching, right? And I have my interest of being paid, getting paid or something, and you have your interest of getting the knowledge and then preparing for the exam and passing the exam. So for this whole arrangement, this is the exchange of interest, right? Now, from the accounting point of view, you have types of transactions. One is cash transaction, one is credit transaction. Cash transaction, where the cash is involved on the spot, like buying anything for cash. So in types of transaction, we have two types. One is a cash transaction, one is a credit transaction. Cash transaction is the one where the cash is involved on the spot. Whatever you buy, whatever you do, you straight away do the stuff with the cash. So that is a cash transaction. Credit transaction, where the cash is involved at some later stage. Like for example, buying now but paying later, selling now but getting the money later. Like for example, you come back from your office and there are some surprise guests at your place, right? So your mom or anyone from your home says that please go and bring something for the tea or bring some refreshments or something or bring something to eat or something, right? So you have a store right around the corner of the street, near your house. So you just go over there while running to get the stuff, obviously, so that you can bring them back, bring the stuff quickly back so that you can serve the guests, right? Now, when you go to the store, you buy the stuff, and all of a sudden, when it comes towards the payment, now you just realize that you forgot your card or you forgot your wallet at the home. Now, you are acquainted with the store owner as well, and he knows you that, or she knows you that you just live nearby and you are a regular customer and all that. So you request the owner to give you the stuff so that you can come back later and then pay. Then he simply says, no issues, you can take it back. You can get the stuff and you can pay me in the evening or tomorrow or whenever you want. It's okay, just take the stuff. right? So you come home with the stuff without paying for it. That is a credit transaction, right? Because the transaction has triggered, the transaction has taken place, but you have not paid for it. So that is a credit transaction, right? Where the money is involved at some later stage. Similarly, we have seen in the companies when you buy the goods on the credit, so the sale takes place, but you have not paid for it or you have not got the money for it. So obviously, it's the credit transaction. Similarly, when you buy the stuff, obviously, you don't pay straight away or something now. So that is what the credit transaction is simply. Right now, after this, we have outcome of transaction, right? Outcome of transaction. Now, overall speaking, the outcomes are asset, expense, income, liability, and capital. Around the globe, around the whole world, around the whole universe, whatever transaction you do, it is always going to have the outcomes from these five, any these five, whatever transaction you can think, you can do the very much of the stress and all you try to figure out for a transaction and all, either it's going to result in an asset, expense, income, liability, or capital. There is no sixth type, there is no sixth outcome, only these five outcomes are there. There is none sixth over here. Right now, what is an asset? Asset is what we own. Anything that we own, right? We have the rights on it, we own it, it's an asset. Like, for example, I mean, as far as the definition is concerned, I'll just talk about the definition first. When it is probable that economic benefit will flow towards the organization, it's called an asset. So when it is probable that economic benefit will flow towards an organization, it's called an asset. Now, the word probable in accounting means when you are more than 75% confirmed that you are going to get an economic benefit. Economic benefit means something in monetary value. So when it's probable you are more than 75% confirmed that you are going to get a benefit in terms of monetary value, it's called an asset, right? Simple terms. You have to be more than 75% confirmed. You have to be probable that yes, you are going to get it. That is an asset. Like, for example, I have the types. But before going towards the types, let's just talk about this is land, building, car, bike, cash, laptop, etc. These are my assets. Then I have non-current assets over here. Non-current assets are those assets whose benefit is for more than 12 months, like land, building, car, right? And a current asset is something whose benefit is for less than equal to 12 months, like cash, wearable items, or we can call as the debtors. Debtors are the receivables. Receivable or debtor are the person, debtor or receivable, the person the debtor is. Done? Okay. So we segregated it into two categories. One is the non-current asset, one is the current asset. Wait, just give me a minute and we are going to resume. Just give me a minute. I just have to take care of one thing. Just 2 minutes maximum. I'm resuming. Just 1 minute. Okay, I'm back. Sorry for the hold. So we were talking about this asset thing over here, and I said that whatever the economic benefit, I mean, if it's probable that you are going to have, it's going to be called as an asset. And if that benefit is spreaded for over 12 months or something, that is going to be called as a non-current asset, or the asset from which you are going to have the benefit for more than 12 months, that is going to be called as a non-current asset. And the asset on which you are going to have a benefit of less than equal to 12 months, which expire in less than 12 months or something, by giving you the benefit, that is called as a current asset, right? Now, this is an exercise that I have to do with all of you as well. I need 100% of your input over here for the sake of understanding and all. I have written the names of land, building, car, bike, cash, laptop over here. Now, one by one. Aisha, it is, I guess. Please tell me one of your assets. Any one of your asset you think that it's your asset, tell me in its name. Then we have the Bamini over here. If you can tell me any of your asset, either you can unmute yourself or you can write. Yeah, Bamini, please. Bamni, you were saying something. Hansley. Okay, Bamni, perfectly. Bamni is saying my house. Yes, you're right. It's your asset. It's your non-current asset. Hansley, I need to know about your asset as well. Okay, Hansley is saying my car. Agreed upon. Miss Aisha, patent is an asset. As yes, you are 100% right. But do you have any patent of your own? I asked your asset. I mean, do you have any patent of your own or something? I would like to know against what you have, like, gotten a patent and on. Okay, then we have Rakshna over here, and Shena as well, Vudushi as well, and then we have Yashvir over here as well. All of you, come on, hurry up, hurry up. We don't have much time. Okay, Answer is saying my car. Okay, Yashvir is saying car, my laptop, my LANF. Okay, I guess you were supposed to say my land. Yashvi, car, laptop, land. These are already told by me. Rakshna, car, land, laptop. This is something I've told you already. Tell me about some other asset of yours. Bamni is saying furniture. Okay, fine. Acceptable. Yes. Shashna is saying my jewelry. Acceptable. Although I've written the wearable items as the jewelry, but it's okay. Ashish, you are asking or telling me that your cash is an asset. You have a question mark. Cash is an asset, but something else. I've mentioned the cash as well. I guess I have mentioned. Yeah, I've mentioned the cash. Any other else? Any else asset you have? Come on, think about. You have lots of assets over there. Look, uh, let me guide you a bit. We don't have to go into the accounting to think about the assets or the type of the assets or the examples of the assets. You go in your home. Photographic equipment. Yes, Bamni, you're right. Photographic equipment. Bilkul, absolutely right. Look, you enter your house, your mom, dad, your siblings, they are your assets. Your room and the stuff inside your room, that is your asset. For example, the bed, the pillow, like, the mattress, the AC, the fan, right? Refrigerator, the fridge, the utensils, all of them are your assets. You own them, right? Your parents are your assets. You own them, as in a sense, rather they own you, right? But still they are your parents, because this is something, the relationships that you have, they are the assets, right? I'm talking about the relationship of the siblings. I'm talking about the relationship of, like, the parents over here. If you're thinking about another relationship or so, believe me, and honestly speaking, before the marriage it's an expense, and after the marriage it's a liability. Honestly speaking, so I'll be telling about you in that, like, as well. So let that be on the side. But apart from that, you know uh anything that you own, that is going to be your asset. Like, for example, if you have the projector at your place, you have the fan, the lights, like, the camera, somebody told me, the photography equipment and all. Similarly, the gadgets that you have, right? So they are your gadgets, your car, your bike, even your bicycle as well. That is your asset, right? So you have so many assets around you as well, right? So these are the ones which you call as the asset over here. Done. Now, afterwards, after the assets, the next one is an expense. Expense means expiration of economic benefit is called an expense. See, when the economic benefit expires, it's called an expense, right? And as far as the expense is concerned, we have its two types as well. Before moving towards the types, let's just talk about what does it mean. Expiration of economic benefit is called an expense. Look, you have a car, right? You go to the petrol station, you get the petrol for your car for like around 1000 rupee, Mauritian rupee, or 2000 Mauritian rupee, right? When you buy the petrol, when you fill your car with the petrol, now it's not an expense. It's not an expense. It's an exchange of asset. You gave away the money, you gave away the cash, you gave away the cash asset, current asset, and you got the petrol asset. At this time, this is an exchange of, assets over here. It's not an expense. Done. Now, you start your car, you put it into the gear, you put down the handbrake, and you accelerate, and there you start moving. You move, you burn the fuel burns, you move, and you travel. The petrol is being consumed, right? So petrol is burning, giving you the benefit of traveling. And once the petrol is burned, it finishes, it evaporates, it gets empties and all, right? So it expires while giving you the benefit. You are thirsty, you go to a shop, you give like around 10, 20, 30, whatever the amount is for a water bottle. You buy a water bottle, right? When you pay, you buy the water bottle, that is not an expense. That is an exchange of asset. You are thirsty, you open the cap, and there you go. Duck, 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 duck. You are drinking the water. As soon as you are drinking, you are finishing the water that is giving you the benefit, it's getting expired. And once, half bottle is emptied, half has been expensed, half is left. So the relationship of the asset and expense, this is something within one single quote, going through and fro motion, and the asset giving you the benefit expires, giving you the benefit, it expires, giving you the benefit, it expires, right? This is what the relationship of the asset and the expenses. It gives you the benefit, it get expires, it's an expense. It has not yet given you the benefit, it has not given you the economic benefit yet, so it's still over there, it's an expense. Oh, sorry, it's an asset, it's not an expense at the moment. So long story cut short, if something gives you a benefit, right, that is an asset. Once it gives you the benefit, it expires, it's an expense. Now we have two types of expenses. One is called capital expenditure. One is called revenue, right? Revenue expenditure. Capital expenditure is if you are buying a non-current asset, it's called a capital expenditure. You spend you spend on your non-current asset in a way that its performance is enhanced, it's a capital expenditure. You spend on it in a way that its useful life increases, it's a capital expenditure, right? So these are the ones which we call as the capital expenditure. Like for example, if you buy a non-current asset, it's a capital expenditure. You spend on it in a way that its performance is enhanced, it's a capital expenditure. You spend on it in a way that it increases its useful life, it's a capital expenditure. Like for example, you have a car and you decide to install, the HID lights, headlights in it. You have the halogen bulbs at the moment, and you decide to install the HID lights. The halogen bulbs, they give you the ability to see up to 500 meters at night. they're light, they give you the ability to see up to 500 meters at night. But once you install the HIDs, you will be able to see up to 1.5 kilometers. Up to 1.5 kilometers. So technically at first you were able to see up to 500 meters. Now up to 1.5 kilometers. So performance has been enhanced. Capital expenditure. You are a VVIP person. You install the bulletproof screens or the mirrors or the windscreen and all, side mirrors as well, right? So the bulletproof mirrors or the glass is going to provide you enhanced security of enhanced security or the safety feature, right? So that is what the performance is basically enhanced, the safety feature of the car, right? Similarly, you install brand new tires of a bigger size. Like at the moment, your car has the stock size of 175, 175. Like for example, I have one car whose size is 175 by 65, rim size 14. And then the Civic I have, that has the the tire size of 215, 85, and rim size 16. Right now, sorry, rim size 18. Rim size 18, sorry. Right? So basically, you install more what do we say, thicker tire, you can say, or more a bigger tire as far as the width is concerned, in order to have a proper road grip, right? So the performance is enhanced. You install the safety grill, on your car, so that if God forbid, in case of an accident or something, the headlights or the front is saved and the impact is on the safety grill, right? So by this the performance is enhanced. It's going to be a capital expenditure. Similarly, you have a house or a building and you apply a protective layer of paint which is not going to let the damage or the wear and tear or the degradation of the building because of the water or something. So that is going to be called as a capital expenditure as well. Now, a revenue expenditure, this is going to be repair and maintenance. Similarly, part replacement. Part replacement is something which is going to be called as a revenue expenditure as well. Now, remember just moments ago, we installed brand new tires. We installed a brand new tire. Now, on the third or the fourth day after installing the brand new tires, we were going on the road, and somehow, some way, we were not paying attention. But unfortunately, our tire got a skid or it got hit with the footpath, right? And it just torn into pieces. And this is a common thing, maybe you guys have observed or not. It's all about the angle, not the speed, rather. It just happened with me once as well. I mean, we know that the side footpath, the side lane on the road, it's normally made up of the small bricks or the blocks that we have now. So basically, I was going in the road and it was all my fault. Basically, I was texting at that time and I was looking at the screen, my mobile screen at that time. Somehow, some way, my car got a bit towards the right side, towards the footpath. And then, on the side footpath, basically, or the divider, not the footpath, but rather the divider that we have in between the road. So there was a block over there which was a bit out because maybe at some time a car or whatever it got hit with, but it was out. This smaller portion, like around 5-6 inches, it was out of a line as well. So by chance, what happened? I was texting, I was not paying attention. So my car got onto the right side a bit, and my bad luck or good luck, my tire got hit with the part of like the divider which was outside. My tire got hit with it. So what happened? I was going at like around 50-60 speed, not more than that. My tire just got burst like anything. I mean, thanks God, I was safe and the car was safe as well, everything. And that's like, the tire just got torn into pieces like anything, like, as if I had a tire blast or something, like, And then obviously, they were the new tires, by the way, at that time. I do still remember at that time. And that is something like, torn into pieces and all. So that tire cannot be claimed in the warranty as well. So I had to buy two new tires. Both of my tires, they got busted. So I bought the two new tires, same category, same size and everything. Now this is a replacement. This is a part replacement. This is going to be a revenue expenditure. Why? Because the performance is not enhanced in any way over here. Before the accident, the performance was over here. You install the brand new tires, same category, same size, same everything. It's gonna restore to its original level. It's not going to enhance it up, right? So this is going to be a revenue expenditure over here. Same goes with the running cost of the repair and maintenance of the car, as if like after every 5,000 or 6,000 kilometers, you change the engine oil, you change the oil filter, air filter as well. Huh? You spend this amount. And why do you do? So that you can keep your car in a mint condition, right? You get your car washed from the service station now and then, so that the car is always clean and it's always like free from the debris and all and everything, right? So the intention basically behind is to keep it top notch and keep it uh, 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 issue free or any problem free, right? Now this is what the repair and maintenance, these are going to be the revenue expenditures over here. So always remember, if you're buying a non-current asset, you are enhancing the performance or the useful life of the asset is increased. That is something you are going to call as a capital expenditure. Rest of the ones, they are going to be called as the revenue expenditure. Done. Then you have income. So income is basically earned economic. Okay. Earned economic benefit is called an income. So when the economic benefit is earned, it's called an income. Like for example, your salary, your profit. For example, you are receiving a rent from some place. You are receiving an interest from some place. So they are the ones which you call as your income over here. So by default, whatever the economic benefits you earn, that is going to be called as your income over here. Right? I hope it's clear. Now, the income has only one type, and that one type is the income only. There's no if you read the book, and in some books, not in the cap, I haven't came across this concept in the Kaplan or the BPP, but at some places there is a segregation of income being written as a capital income or a revenue income. This categorization into the capital income and the revenue income is just for the sake of understanding. There is no accounting standard about it. The standard or the conceptual framework on which the whole of the accounting is based upon, it doesn't do any segregation between the income. It's just that for the sake of understanding, you are saying one is a capital income, one is a the revenue income. Capital income is the income that you earn via selling your non-current assets. I mean, the explanation which is written over there. that if you sell your non-current asset, the amount that you generate, that is a capital income. And if you are doing a normal selling, sale purchase in your business, that is the revenue income. I mean, this categorization has never been understood, and that has never been, I've never been able to digest this because this is illogical. This is illogical. But still, in some books, for the sake of understanding, okay, fine, I agree. For the sake of understanding, to some extent, you can say that one is a capital income, one is a revenue income. Fine, agreed upon, no issues. But I'm not going to write it over here because there's no such concept. Done? Now, after the income, we have a liability. Liability is what we owe. Whatever we owe, whatever we have to pay, whatever we have to give, and we have to give no matter what, that is called as a liability, right? Now, liability is a present obligation arising from some past event, the settlement of which will result in an outflow of economic benefit from the organization, right? So a liability is a present obligation arising from some past event, the settlement of which will result in an outflow of economic benefit from the organization. It's called a liability. So whatever you have to pay, whatever you have to give, and it's arising because of some past event which just happened, and it's going to result in an outflow of the economic benefit, it's going to be called as a liability. Now, even if I try to translate this definition hundred of times to you, you won't be able to understand. Let me give you a very teeny tiny example, and that is going to make it clear to you 100%. You go to the office, you come back in the evening, and one day when you come back, right in the garage, or in the porch of your house, or in the parking area, you see a twisted paper over there. Normally, this is what happens basically at my place. I come back normally, and then normally we get the electricity bills over here, on a pink paper. Basically, the color of the paper is pink. By default, the society has decided to give the electricity bills on the pink paper. Basically, we have the private supplying company over here, not the government ones. Basically, this is the society's own grid station which is giving us the electricity and all that. So they have the pink paper basically over here for us, on which they print the electricity bill. And whenever, believe me, I see, my heartbeat just simply stops and my heart sinks that, okay, now we have a big fortune to pay in the name of the electricity expense and all that. So basically, I came home, or you come home, and you see the bill over there, and you open it up, and that is an electricity bill. So now it is a present obligation. It's a present obligation. As soon as you get the bill, it's a present obligation that you have to pay the bill arising from some past event. Past event means, obviously, when you came home, when you got the bill, and this time you got the bill because for the previous whole month you have used the electricity, na? So that is why this bill came, na? Right? So arising from some past event. So the past event has been that you used the electricity for the whole month. So that is why the bill came. It can never happen that you have to yet use the electricity and you get the bill. No, it never happens like this. You use, then you give the bill. Technically, you use, then you give the bill, right? So a present obligation arising from some past event, because for the whole month you use electricity, the settlement of which will result. Now, you tell me, how do you pay the electricity's bill? How do you pay it? Someone's gonna say, by doing an online transfer. someone is going to say, we go to the bank and pay, and someone is going to pay the logically, sir, we pay it via paying the cash. We pay it via paying the cash, giving away the cash. Cash is an asset is an economic benefit. And when you go to the bank or something, you take out the cash from the pocket and there you pay. You take out the cash from the pocket and there you pay. So this is an outflow of economic benefit from the organization, right? So it's going out. This is what the liability is. A present obligation arising from some passive event, the settlement of which will result in an outflow of economic benefit from the organization. Now, the liability has two types. One is called as a non-current liability, whose settlement is for more than 12 months, and then one is a current liability whose settlement is for less than equal to 12 months over here, right? Like, for example, in the non-current liability, we have long-term loan, we have lease, we have mortgage, etc. In the current liability, we have short-term loan, we have payables, we have bank overdraft. Okay. Now, long-term loan. You got a loan for 5 years, 6 years, 10 years. That is going to be a non-current liability because this is something which is going to settle in more than 12 months. You have a lease. You get a car leased from the bank for 2 years, 3 years, 4 years, 5 years, right? So that is going to be a non-current liability. And then you have the mortgage. When you buy a real estate property, for example, land, building, land, building, house, flat, right? So that is something. This is the real estate property, na? So you buy it on installments. It's going to be called as a mortgage. Short-term loan, 4 months, 3 months, 5 months, 2 months, 1 month. Payables, payable is the party or person from whom you buy the goods on credit. And then bank overdraft. Bank overdraft is a facility being given to you by the bank. Being given to you means given by the bank to the business accounts, basically, where they allow the balance to go in negative. Like, for example, you have 10,000 in your accounts and you have given a check for 12,000 or something now. So bank is going to offer you a overdraft limit that you have a balance of 10,000, but now if you want to, you can pay for the 12,000 as well. And your balance is going to go in 2,000 negative. The bank is going to clear your check from its own pocket, and it will show your balance as 2,000 negative. Now, obviously the bank is going to charge a fee for this whole arrangement. When next time when you are going to have an inflow of 8,000 now, that 2,000 which you owe to the bank, it's going to be deducted from here, and then your revised balance is going to be at 6,000 over here. So this is what the bank overdraft is. Then moving ahead from here, now we have the capital. Capital is basically the investment, right? It's the finance that you have within the business, and it's called as invested economic benefits by the owner of the business is called capital. Invested economic benefits. That is, for example, you have the money, you start your business. You have a car, you start a business of rent a car. You have a bike, you start a business of rent of bike or rent a bike, right? Similarly, you have a house, and you start a hostel with it or something. So that is the investment that you are doing. And these car, cash, bike, these are all the economic benefits over here, right? So one thing in common, look, when it is probable that you are going to get an economic benefit towards you, it's an asset. So the economic benefit is the asset. When that same asset is expired, it's an expense. When that same asset is earned, that is an income. When that same asset has to be paid or has to go out to settle your obligation, that is a liability. And when that same asset is invested, it's a capital, right? Now, we have a movement of capital with us at a period start. When a period starts now, you are going to have a capital called as opening capital. In this, you add capital introduced. In this, you add the profit for the period. In this, you less the loss for the period. In this, you less the expenses for the period. In this, you less the drawings for the period. And then when the period ends, it is called as a closing capital. Okay, sir, drawings. When the owner of the business takes cash or any other asset from the business for personal use, it's called drawings. So when the owner of the business takes any cash or anything else from the business, like any goods or something from the business for the personal use or something, that is going to be called as drawings over here, right? Okay, I hope it's clear to you. Now, let's just have a break of 5, 7 minutes or so. Let's just get up from our seats, walk around a bit, and exactly in 5, 7 minutes, we are going to come back and then we are going to resume. Let's have a break. Okay, I'm back. So let's resume now. After the outcome of transaction, we have a concept over here called as a duality concept. Duality concept means every transaction will always have at least two outcomes. Dual means two. So every transaction will always have at least two outcomes, right? And basis on that, on the basis of that, we have an equation called as an accounting equation. Accounting equation is assets is equal to capital plus liabilities over here. Accounting equation is assets is equal to capital plus liabilities over here. Now, we have an accounting equation. Mr. A started business with $10,000, right? Now, if I look at this 10,000, this is a cash, which is an asset. This 10,000 is an investment by the owner, Mr. A. So that investment is basically called as the capital because this is the amount via which the business is starting over here, right? So now if I want to put in over here, as far as the accounting equation is concerned, this one, if I want to put it over here, then I can write it cash, the dual effect. One is the cash, which is 10,000, which is equal to capital. So now we are going to have the capital over here, which is again 10,000 plus liabilities, which is going to be zero over here, right? So this is what the picture of an accounting equation is going to be. Asset is equal to capital plus liabilities, right? Number two, he purchased balloons for 2,000, carriage cart 1,500, and a gas cylinder 500 for cash. Now, what he did with the 10,000, out of the 10,000, he purchased the balloons, a carriage cart, and a gas cylinder. So basically, Mr. A is starting the business of the gas balloons, basically, the helium gas balloons, basically, right? So if we look at this transaction, what is going to happen? Balloons, carriage cart, and a gas cylinder. New assets are going to be created over here. And the other effect of that is the cash asset is going to decrease over here, right? So basically, balloons, carriage cart, gas cylinder, the new assets are created over here, and the cash, the existing asset, is going to have a drop over here, right? So if via the accounting equation I have to write it, I can say balloons plus, let's have it like this, carriage cart plus, okay, I'm unable to set it up. Okay, gas cylinder plus cash is equal to capital plus liabilities. So I have balloons worth 2,000, carriage cart 1,500, gas cylinder 500, and everything for cash. So the remaining cash over here is going to be 10,000 minus 2,000 minus 2,000, 4,000. So I'm going to have 6,000 is equal to capital 10,000 plus liabilities 0. Third point, he sold all the balloons for 4,000 cash. Now, he has sold all the balloons for 4,000 cash. Now, what is going to happen over here? These balloons are sold, so this asset is going to decrease. We have received the cash, so the cash asset is going to increase. Plus, a third outcome is going to be over here as well. A third outcome, and that is we have earned a how's it gonna be over here now? So balloons, they're gonna go nil. We have the cash over here. So we had this cash 6,000 plus 4,000 is equal to capital plus profit. So this 10,000 plus 2,000 as well, right? So 10 plus 2 is 12,000 is equal to 6 plus 4, 10 plus 10 and a half, 11 and 12. So 12,000 is equal to 12,000, right? Then we have point 4. He took 1,500 for his personal use as well. Now, he has taken out 1,500 for his personal use. Just give me a 1 minute only, please. Okay, so we were talking about he took 1,500 for his personal use. Now, this amount which is taken out for the personal use, it's called drawings, right? Now, how to account for the drawings over here? Obviously, we have these balloons and everything now, so I'm going to copy this up. So here we go. Here we go. Now, we had this cash. Now we have a total balance of 10,000 minus 1,500 as well, right? This capital is now 12,000 minus 1,500. So now look, 1500 has been deducted from cash. 1500, the drawings has been 100 is 10,500 is equal to 85, 9, 10 and a half. So 10 and a half is equal to 10 and a half, right? Further, balloons for 2000, this time on credit. The credit. So basically, what's going to happen? Balloons, the asset are going to increase. And as you have bought them on the credit, so a liability is going to increase as well. Why? Because we just bought them on the credit. It means sooner or later, we have to pay for them. So sooner or later, ultimately, we have to pay for them. So technically speaking, this is something that is going to be called as a liability. Simple, right? So I am going to copy this up, and this is going to be balloons. This is going to be 2000. Carriage card as it is, gas cylinder as it is. Cash is going to be now 8,500 over here. And the capital is now left over here. So this is going to be 10,500 over here. And then we have liabilities of 2,000. So 10,500 plus 2,000 is 12,500 is equal to 8. So point to be noted, after every transaction, accounting equation is balanced. After every transaction, the accounting equation is balanced over here, right? Like for example, 2, 3.5, 4, 4 plus 8 is 12.5. So 12.5 is still equal to 12.5. Simple, right? Now, next point. He sold half of the balloons for 2,000 on credit. Now, he sold half of the balloons. So out of 2,000, half of the balloons, that's for 1,000, have been sold for 2,000 over here, right? So what's going to happen? But on credit as well. Right? So what's going to happen over here? Okay. These are the balloons over here. What's it doing? Okay. Now, half of the balloons sold. So we have 1,000 of the balloons left over here. Now, over here, we have, okay, I hate doing the work in the Word file. Next time we'll be doing in the Excel. Plus debtor for 2,000. So we are going to have a debtor of 2,000 over here. And as these balloons, 1,000 balloon being sold for 2,000, so we have a profit element as well. Right? And the profit element is going to be 1,000 as well, because 1,000 balloons sold for 2,000, right? So we have 10.5, 11.5, 13.5. 13.5 is equal to 85, 10.5, 11, 12, 13, 13.5. So 13.5 is still equal to 13.5, the right side. Done? Now, point number 7. The payment to the creditors were made. You made the payment to the creditor. That is the liability that you had. That you paid for it. So when you do the payment now, this cash is going to decrease. You have 6,500 over here. This liability is going to be zero. So 11 and a half is equal to 2, 8 and a half, 9, 10, 11 and a half. And then next point is Mr. A received the full amount from his debtor after a week. Now, what's going to happen? The debtor is now going to have a zero balance, right? The cash is now going to be at 85, and this capital is now going to be at 11,500. This is going to be eliminated from here. This is going to be eliminated from here. So 11 and a half is equal to 85, 9, 10, 11 and a half. 11 and a half is equal to 11 and a half, right? Counting question balanced, right? So this is what we have over here. Now, moving ahead from here, I would like to show and share, and let me just open it up. Here we go. Okay, this is the financial accounting set one that I am going to share with you in a while. Chapter number 1 is business concepts. So these are the little we are going to learn these concepts one by one for sure. Now let's just scroll down to the chapter number 2. We have accounting and business equation. Assets is equal to capital plus liability. If we scroll down, practice questions. Mr. A starts gas cylinder, carriage card, sold a balloon, drawings. Exercise number 2, 3, 4, 5. 5 exercises are separate over here. I just took what I had to and I made them into one exercise and it's done. Now, sir, ladies and gents, this exercise number 6, Mr. A started business of fruit and vegetable selling with 1,000. This exercise is your homework, right? What I want is tomorrow is Saturday, right? The weekend. So enjoy it. No need to work, right? On the Sundays or the Monday, Tuesday, Wednesday, wherever you want to, you are going to solve this exercise, right? And then you are going to share it with me on the WhatsApp. The group is going to be created soon. As soon as your enrollments are done, as soon as you guys are done with the enrollments and all and everything, the WhatsApp group is going to be created. I'll be there over there as well. Or meanwhile, if the group is not created, what you can do is you can drop a message to the coordinator, and the coordinator, and you can send it to the coordinator as well. And then the coordinator will use her means to send it to me. I'll have them no matter what, right? But this exercise, sir, it has to be done before the next class so that what we have learned, I want to ensure that at the end of the day you have done its practice as well. Now, as far as getting the file is concerned, all of you guys are over here. This is the chat, and this is the message to everyone. This is the file, my computer. Now F3 online. This is set 2. Here we go. This is set 2. Okay, I have sent the document on the chat. Open the chat right now. You will see the financial accounting over there, right? I have shared it over there. So just click it open and save it. Click it open and save it. right? And with this, once you guys settle down and all, now I will be sharing this one as well. Okay, these are the extracts from my two different books. Now, over there, that was the chapter number 1 and 2. Those are the concise notes and the book. This is the another book as well. We have the business transaction and the accounting equation over here. So we go with the theory, right? We go down, then we have the double entry as well, the transactions as well, and then we have these class practice questions over here in the form of the MCQs, the way you guys can expect to have in the exams, right? So we have around uh, 32 questions over here, the class practice, and then we have its relevant answers over here. Similarly, I have the home assignment separate as well. So I go down, I have 32 questions over here as well. 64 MCQ questions over here, apart from the Kaplan and the BPP. This is something you guys are going to get as well, right? So be honest with me. If you are doing 64 questions over here, then we have the other practice material as well, right? You are doing the Kaplan, you are doing the BPP. Then we have the ACCA study hub as well. Over the course, I'm going to guide you once you get yourself registered with the ACCA, how you are going to access that study hub as well. So be honest and tell me, when you are doing this ample practice, I mean, apart from the God, there is no other power on earth which can stop you from passing the paper, honestly speaking, right? So there's much a lot you are going to have for the sake of the practice and everything. So don't worry about that. But I mean, you don't need to buy, as far as the books or the exam kits are concerned. I mean, if you want to have it into the hard form, that is a separate thing. But as far as the book and the kit is concerned, once you guys get enrolled and all, now, I will be sharing a Google Drive link with you as well. And I will put the latest exam kit and the books over there as well. The books and the exam kits over there. I try to get my hands on the latest one in the PDF form. So I will be sharing those as well. If you are comfortable in having a hard form, go for it. If you are comfortable with the the short form as well, with the PDF as well, you can go on with that as well. It's your choice. It's your choice, whatever you want. I mean, you can go on with that, right? So this is as well, like this is the first chapter that you are going to have. Similarly, with this, you are okay. This is set one. Okay, you have the okay, yeah. I've shown you the chapter number 1 over there, but again, you have the double entry and the stuff which you are going to read now. So you have its practice questions as well. So you have ample practice. I mean, in the coming days, I will be sharing each and everything with you. So everything is going to be available. Basically, I don't want to rush and start another topic because this is the foundation, and ACCA call this level as a foundation level as well. I have to ensure that at the end of the day, your foundation is strong over here, basically. So I don't want to rush. Next time when we are going to meet, we will be talking about the double entry and all. Not right now. Double entry is something that is going to be the pure, accounting language, which we'll be talking about and we will be dealing with, right? So at that next time, I mean, we'll go on with the extra time and all and everything. But let's not rush right now, right? Because I try to, build up the foundation, and this foundation needs a time to settle down as well. And that settlement period is something when you are going to do the practice. So I'm going to stop over here for the day. If you have any question or anything in mind that you want to add or you want to ask, you can. Plus, I want to have a feedback about today's class as well. from you guys about what's your opinion regarding the class. I mean, should we continue like this, or you want to suggest that we should incorporate something more in it, or how we can have it more, interactive and more fruitful for us. Exam kit questions are there, but obviously we have to cover some topics first before we jump towards as far as the exam kit is concerned. I've shown you the topics and the chapter from my own book as well with the practice questions and all and everything. But I'm not going over there right now because I need to have a solid base over here at the first. Once the solid base is ready, then we are easy and we are able and we are good to go with those questions. Not right now, right? So please, time for the feedback. Please tell me if you think everything is fine or you think that we should change or incorporate anything. Yes. I mean, come on, anyone. Now all of you are shifting. Okay, on the typing side. Okay, Bhavani is saying it's fine on my side. Okay. I guess some other students were over here in the class as well, apart from the Bhavani. Shashna is saying fine on my side too. Okay. Okay. I hope, I mean, from fine it goes to the towards the good side when you're gonna say that it's good on my side, huh? I hope for that as well. Anyhow, uh time to say bye. All good. Okay, Hansel, thank you. I knew about you that you're gonna say it's good, huh? I knew. Because if you have been happy in the MA, so technically you will be happy over here as well. Okay, Yashvi is saying great session. Okay, thank you, Yashvi. Okay, so okay, Miss Wood is saying something as well.
Sorry,
Thankful,
sir.
thank you for
I
the
have one
compliment.
question,
Yeah, sure,
sir.
sure, sure, please.
Yeah, will we have a WhatsApp group for this one also?
Yeah, we are going to have a WhatsApp group for the FA separately as well. For every class, you are going to have an individual WhatsApp group. For this, you are going to have a group as well. I guess the group has not yet been created, right? Because this is something which is done by the coordinator once the enrollments are confirmed and once the enrollments are there, right? So once you get your enrolled yourself, and once the trial session is over, basically, right? Because I guess first or second lecture, first two lectures are the trial ones now. So once that is over, you'll have the WhatsApp group. That is why I took the liberty to share the document over here, so that we don't have to wait for the WhatsApp group. And even if it's not created and you're done with the homework, drop a message to the coordinator to send the file, right? So once the group is created, 24/7 I am going to be available for you. It doesn't matter you are sitting and studying quite early in the morning or late at night or after midnight as well. No need to think anything, just straight away send a message onto the WhatsApp. If I'm not sleeping, I'm not eating, and I'm not in my other class or something, I will straight away respond to you. And if I'm busy or something, obviously, if I'm eating or in the class or some other stuff, at least I will drop you a message that I will get back to you in like around 30 minutes or an hour or so, or whatever the time, right? So as soon as I get free, I'll respond to it. Because remember, this whole arrangement, this whole session is for you guys. So we at the academy, we try our level best to be as accommodative as we can, right? So that, because at the end, look, if you succeed, if you are happy, we succeed, we are happy. Simple. End of story. Period. Right? So tomorrow's a weekend, you have to enjoy it to the fullest, and then on Sunday as well. And then when the Sunday evening, when you are tired and have nothing to do, open up whatever we have learned so far, go through it. And I am going to see you on next Friday with the topic of the double entry, the start of the double entry, how we do it, how we have to take it into account, or how the stuff works on Move. Everything we are going to talk about in our next class. And for that, you have to wait for the next Friday, same time, same place, same channel. Till then, take care of yourself, your family, your friends, and the people around you. Have a lovely weekend. Take care. Bye bye.